So here's what's going on. Markets are paring their earlier gains after wholesale inflation came in lower than expected for December. That PPI number, yields are actually now up. They had moved lower earlier on the 10 and the 2-year. Let's get the read from Kingsview Asset Management CIO Scott Martin. Scott, there's been a real reversal here. We had a strong triple-digit gain. When this econ data crossed at 8:30, that's all gone. What's happening?
It's bizarre, isn't it, Cheryl? I mean, what does the market want here? We got a cooler than expected report, and the market reverses, meaning rates go up again and equities go down. So I'll tell you what, Cheryl, I think this is all about the Fed. I've been talking about this with you and others on the network for the last 3 months. The Fed is offsides here, and they need to get control of interest rates like Janet Jackson did back in 1987, one of my favorite albums in the world, because they don't have control over interest rates. I mean, they're cutting rates, Cheryl, in an economy that is growing jobs, growing overall as far as GDP. Showing the stock market going up as we did at the end of the year. And now rates are just skyrocketing with the Fed cutting on the short end. Something else is happening here. I think it is an inflationary story. But then again, a day like today kind of puts that to rest. So we have to be careful here as we go forward because the market is not acting right.
A lot of news is coming out today as we are now in the final countdown mode and days until the inauguration next Monday. And one of the headlines here on Wall Street Journal is that President-elect Trump plans on day one to sign dozens of executive orders. We know that. But this one is going to focus on fossil fuels, energy dominance, if you will. Also taking away a lot of the electric vehicle mandates that have been in place. Look, he ran on this during the election. We know this is coming. But I'm wondering if the energy sector continues to be a play for you as we move into the next administration.
It does to some degree. It depends how you play that. I think some of the integrated oils are great, like the Exxons, the Chevron. Cheryl, we've been playing a lot of the pipeline stocks and the pipeline ETFs that are out there, which have a higher yield than some of those integrated energies. So if you're looking at some places to go with energy, I would look at pipelines versus, say, maybe those individual stocks themselves or the ETFs that do that. AMLP is one that we use and we have used for the yield and the appreciation. But Cheryl, you're right. The executive orders are things that are probably scaring the market, I think, a little bit because it's a lot at a short period of time. It's a lot to take in right away. Some of those executive orders I agree with. Maybe some might be a little bit tentative and maybe a little bit too soon. But overall, there is a change here, a sea change, if you will, and the market needs to get used to that. And that's, again, back to why the Fed is screwing around here. 50 basis points in September, 25 more in November, 25 more in December. Now what are they going to do? Now we're hearing possibly, Cheryl, that they may actually raise rates this year because rates are going back up because inflation is a concern. The Fed has no idea what they're doing. They're not integrated with Donald Trump. And so there's things that are going on here that I think the market is trying to take in very, very quickly, and that's why we're seeing all the volatility.
Well, I think my point, though, in particular with the energy sector, is that you're going to see likely pressure on Brent and WTI, natural gas. He's talking about restarting LNG exports to Western Europe, for example. All of those things would actually keep energy prices in check. And that's the inflation story, which would be a good thing for the consumer. But you're right. The Fed is going to have to make some difficult decisions, especially if we're looking at only one rate cut. The other thing is we're getting all the banks tomorrow, and I'm looking at these estimates now for what we're going to see. J.P. Morgan, Wells Fargo, Citigroup, Goldman, BlackRock, Bank of New York Mellon. That's all tomorrow, along with December CPI. So we're going to have two major news stories to wake up to. We're going to have inflation on the consumer side, and then we're going to have all these bank earnings. What are you expecting?
Inflation should be right in line, so I don't think that's going to be a big deal. We saw that a little bit with PPI, a little bit softer that we saw today, but I think consumer price index could be maybe just a little bit online, maybe just slightly higher, but I don't think that'll scare the markets too much. The financial earnings, though, Cheryl, to your point with the yield curve steepening, with rates going back up, should actually be good for the financials. I remember back in the day, a couple years ago, and certainly a year ago, everybody's talking about how financials were doomed, especially the regional banks. They've been one of the best trades so far this year, and I think they will continue to be because banks are sound and they're ready to roll. But the problem is, too, is if the Fed does get back involved here, does mingle with interest rates, God knows what that's going to do to the banks. But at least as far as earnings go tomorrow, as they start with financials, I think the kickoff is going to be pretty good.
You do. Okay. And real quick, healthcare and technology are under pressure today. A lot of our guests are coming on and saying that they're waiting for those buying opportunities, in particular if it's like a NVIDIA or a Palantir. Are you in that boat right now?
We are, and we still own a lot of those names, Cheryl. We've written them up, and we've taken off some profits along the way, and I think these are long-term buying opportunities that you have to just wait for kind of that capitulation, those big days where a Palantir, an NVIDIA, a Microsoft, a Google is down, say, 5, 6, 7% or something like that in a couple days. Those are times to jump in because then the reality is going forward with these stocks, they're going to be good long-term holds.
All right, Scott Martin, thank you so much, Scott. Appreciate it, and we're not going to focus our attention